Hi, my name is Eric Blattner with Divvi Wealth Management, and today we are going to talk a little bit about direct or custom indexing. So let's get started. First, what is custom indexing? And start by looking at the subheader here. The goal is pretty simple. We want to use custom indexing or direct indexing to deliver tax efficient market-like returns. That, in a nutshell, is what we're trying to accomplish. So when we talk about market returns, the first question should be, which market? And the good thing about custom indexing is that you have, or we have, the ability to target broad markets, narrow markets, individual segments, and there's a lot of flexibility to determine what the underlying index or market exposure is that we want to try to mimic. So if we want to think broad in terms of like the S&P 500, that's certainly doable. If we want to think much more narrow and just focus on an individual sector like financials or information technology, that can also be done. The other pieces that I think are the most important to cover with custom indexing are the tax efficiency. We're going to talk a little bit more about some of these details, but that's certainly a big piece. Also, the ability to customize. It's professionally managed, and the minimums on these strategies continue to move lower. 5 or 10 years ago, I think it was fairly common to see minimums of at least $250,000, and now those in certain situations, depending on which provider you talk to, can even be obtained for less than $100,000. So they continue to move lower over time, which is a good thing. Now, when we talk about direct indexing or custom indexing, what are the benefits? And one of those benefits is realized losses. Now, in the investing world, we generally talk about gains and making money. That's usually a lot more fun. However, losses are a very real part of investing, and when used properly, they can be a benefit to investors from a tax perspective. So we think of losses as part of your broader tax strategy, and so when you have gains, capital gains in your portfolio, you're usually going to be, you usually have to pay a tax. There's a capital gain tax depending on your income level that's generally going to be either 15 or 20%. And so, as an example, if I sell a stock, I bought it at $100,000, or I bought it with $100,000, it's grown to be worth $200,000, and I sell it all, that $100,000 return to capital comes back to me tax-free, but that $100,000 gain is going to be taxed at, let's call it 15%. So I'll have a $15,000 tax liability come next April. Now, here's where the losses can come in. Losses can be used to offset gains. So if there are other parts of the portfolio where I might have $100,000 in losses, then I can use those to offset. And we're going to talk a little bit more about the realization of losses, but that's the main idea, is that you can use losses to offset gains, either in the current year, or these losses can be carried forward. So I'm recording this in 2023. Let's say, hypothetically, I don't have any gains that I've realized in 2023, and I want to push those losses forward in 2024 or 2025. They can be carried forward indefinitely. So it's a pretty sizable benefit. Now, I know my head is in the way of the bottom right-hand corner here, but we wanted to compare these custom indexing strategies to a few other more common structures that folks should be familiar with. The first on the far left-hand side is going to be mutual funds. Then in the middle, we have ETFs. And then on the far right-hand side, there's this concept of custom indexing. And I'm going to use custom indexing and direct indexing somewhat interchangeably. So along the first column here, how do you own it? With a mutual fund and an ETF, you own the fund shares. It'll be a single line item on your statement. As opposed to custom indexing, you're going to own each of the underlying securities. Again, let's look at the S&P 500 as an example. If I own an S&P 500 mutual fund, maybe from somebody like Fidelity or Vanguard, I own that one fund. Same thing with an ETF, maybe from iShares or Vanguard or State Street, I own that one single ETF. And if I own the S&P 500 and a custom indexing strategy, I'm going to own hundreds of individual stocks. And you look down the list from some of the biggest names in the S&P 500, companies like Google, Apple, Nvidia has been all over the news with the growth of AI here in recent months. Meta or Facebook. You start going down the list, you're going to own little slices of each of those individual companies. Now, we'll actually save that for a little bit later. The pricing for funds, you generally do business with the mutual fund, or you transact with the fund at something called a net asset value, NAV. Mutual funds are priced once a day at the end of every day, and that's when all the transactions will be priced. ETFs are a little bit different. They're traded on an exchange. That's what ETF stands for, exchange traded fund. So you can transact throughout the course of a day. Same thing with custom indexing. You're buying the individual stocks on an exchange. Now, what about the ability to customize? Obviously, with the name custom indexing, you would expect customization. You certainly can. We'll talk more about that later. Cost. Mutual funds are going to vary, but generally the cost of mutual funds continues to come down, especially if you're talking about indexing strategies like this. Same for ETF. And custom indexing is a little bit different. There's generally going to be, because they're professionally managed, they're generally going to be a little bit more expensive than an ETF, perhaps not as expensive as a mutual fund. It varies, but you can find a lot of custom indexing strategies in the neighborhood of 12 to 25 basis points or somewhere in that ballpark. But just know that there is going to be a fee associated with it. Tax efficiency. Mutual funds are a little bit different. They're generally going to be the least tax efficient on this list. Again, indexing mutual funds, not a big concern, but if you talk about actively managed mutual funds, then those can be inefficient, at least from a tax perspective, over time. ETFs, very tax efficient structure, and then custom indexing, again, one of the primary benefits is the tax efficiency. Let's talk about funding. How do you buy mutual funds and ETFs? With cash. What about custom indexes? You can actually use other securities, other holdings in your account to fund those custom index strategies. Again, we'll talk more about that in a second. How about the ability to rebalance? With mutual funds and ETFs, those are going to be at the manager's discretion. Generally, the index provider will rebalance their constituent holdings every so often, and when that happens, the manager of the fund that tracks that index will make the corresponding adjustments. With a custom index, you really have the ability to determine when you are going to rebalance those dollars, and a lot of it will be dependent upon how much tax you're willing to accept, how many capital gains you are willing to realize. And then finally, what about withdrawals? So with mutual funds, those are generally going to be based on cost basis and tax lots. Same with ETFs. And with custom indexes, you can pinpoint individual securities that you would like to sell. And there's opportunities there to potentially sell securities that might be positioned better from a tax perspective. So perhaps don't have big gains, or maybe you've already realized enough losses this year and you want to realize some gains. You have the ability to do that without impacting your tax situation. You just have some flexibility and choice in that regard. Let's take a look at an example. Now, the circle chart, donut chart on the right-hand side of the page here is going to compare the Vanguard Mega Cap ETF. That's the brown circle, and you see the ticker in there. So you own that one ticker, versus a custom index, and that's the outside ring of the donut. Those are the green slices. And you can see that you own each of these individual slices directly. Now, there's some nuance here. With direct indexing, you probably will not own all of the underlying securities. But for the purposes of this conversation, I think it's okay to at least understand that you will own several hundred, perhaps, individual stocks as opposed to that one ETF. The big benefit that we talk about here with custom indexing, tax loss harvesting, when you think about it from an ETF perspective, you need the entire market to be down. So if you think about years like 2008, maybe 2018, 2022, those may have been some opportunities to do some tax loss harvesting because stocks broadly were lower. And if you hadn't owned this ETF for a long period of time, perhaps you could sell it at a loss and replace it with something else that give you a similar look and feel, and realize those losses to offset future gains. That's how you would essentially go about tax loss harvesting with an individual ETF. With custom indexing, you have hundreds of options. You're going to see here in one of the next slides just how many stocks on an average year are down, even when the market in general might be up. So that mega cap ETF might have a return of 10%, but there could be dozens, if not hundreds of stocks that have poor performance during the year, giving you more flexibility and more opportunities to realize some of those losses over the course of the year. This is that chart that I mentioned. So this is from one of our partners, Orion, and they looked at the Russell 3000, which is an index that covers the largest 3,000 companies in the United States. The largest 3,000 publicly traded companies in the United States. And any given calendar year, stocks are up, stocks are down. And you can look at the table at the top of this slide, and you'll see the number of companies in the index that had positive returns, and then in the middle row you'll see the number of companies that had negative returns, and then of course in that bottom row, what did the overall market do? So you look at 2011, there were over 1,200 companies that were up during the year, but there were over 1,800 stocks that were down. So again, if you think about this from a tax loss harvesting perspective, there are a lot of opportunities to realize those losses, replace the stock with something else that should give you a similar type of experience. That's the idea. And so the point of this chart clearly is that in any given year, there historically have been lots of opportunities to realize losses from individual securities, much more so than if you were to just own the ETF, where by and large there's a bias towards positive performance, or at least there certainly has been. So that's I think a unique piece of this custom indexing strategy. Now let's talk about customization. If you look again at the chart on the right-hand page, it's easiest to read bottom up. So you're going to start by defining that market exposure. Do you want broad exposure? Do you want narrow exposure? Do you want it to be United States? Do you want it to be foreign, global in scope? Understand what market exposure you're trying to get. And then are there any tilts that you want to make inside the portfolio? And one of the things that we talk about is owning quality businesses. We want to own good quality businesses over time. We think that's going to give us the best chance, or one of the best chances, to not only make money, but do so in a way that brings us, I guess, some peace of mind from a behavioral perspective. Our ability to stick with a strategy, we think, is greater when you own quality businesses. So you can make some of those tilts. Quality is not the only one. There's plenty of ways you can tilt the portfolio: size, value, momentum, things along those lines. And you have the ability to do that in a custom index. You can also manage around concentrated positions or industry exposures. If you work in, let's say you work in the software industry, and you decide that you've already got enough exposure to software through your job, either through your wages or through company stock that you might have, then perhaps you want to exclude software companies or a segment of the software industry from your custom index. You can do that. And then finally, you want to balance the tracking error and the tax loss opportunity. So when we talk about delivering market-like returns, we're going to need a little bit of wiggle room to realize some of those losses. So you kind of have to decide how much variance are you willing to accept. So if the market moves this much every day, are you willing to accept a little bit more, a little bit less, things along those lines. So it's not going to be a perfect identical match to the market that you're trying to index or trying to own, but ideally it should be very, very close, especially if you're willing to forego some of those tax loss harvesting opportunities. If you want to be more aggressive with tax loss harvesting opportunities, generally you have to be willing to accept a little bit more variability in terms of how your investment tracks the underlying market. Hopefully that makes sense. And then once you make all those decisions, what's left is your custom index, the one that is designed for you and tailored to meet your specific preferences, needs, objectives, things along those lines. Pretty cool. So what are a couple potential use cases? One of the biggest is going from a concentrated portfolio to a much more diversified portfolio. Ownership of public company stock, particularly employer stock, is historically has been one of the best ways for Americans to create real wealth. And there's pros and cons to everything. So individuals that have worked at a company for 20 years may walk away and have more money than they ever dreamed they'd have. And a lot of that is or could be concentrated in the employer's stock, the company that they worked for all those years. And so if you don't have a transition plan in place to minimize that tax liability, you could be looking at a very, very sizable capital gain. Imagine someone who retired with $20 million in company stock. And if you think about, especially if most of that was acquired at very cheap prices with no transition plan, you could be looking at 20% capital gain, which is a $2 million tax bill if you try to diversify it immediately all at once, which maybe that makes sense for the right individual, but I don't know a lot of folks that are going to have the appetite for that kind of a tax bill in any given calendar year. So one of the things that you can do is you can use some custom indexing to generate losses and slowly start to transition that portfolio, especially if you've put some protections in place around that concentrated position. You can use the custom indexing to realize some of the losses and offset those gains as they're realized. And during that transition plan, when you go from a concentrated portfolio to a more diversified portfolio, that's the concept. Another piece is going back to the customization. So again, we talked about tailoring to meet the individual investor's preferences. If you buy an ETF or a mutual fund, you're going to get what the manager, whatever investments they buy, you're going to own the same ones as everyone else. And that's perfectly fine for many, many folks. But for people who would like to customize, would like to have a little bit more control over how they're invested, custom indexing can certainly deliver on that. So a couple of examples, people might want to be inclusionary of how they invest, meaning I only want to include certain markets. I want to include certain factors in my portfolio, like quality, like size, meaning smaller companies, like value. If they want to have a tilt towards companies with cheap price metrics or things along those lines, that can all be done from a customization standpoint. You can also be exclusionary. So a couple more common examples are removing stocks, removing industries. Again, if you work for that big software company and you have enough exposure there, you might not want any of that company in your custom index, so you can exclude it. There's also a growing number of people who have interest in sustainability issues, and so you might want to exclude certain companies that don't fit a certain behavioral preference. And again, there's no right and there's no wrong here. This is all about customizing to your needs, or to your preferences. And then lastly, the customization for the transition plan. In a lot of cases, you have flexibility to determine just how much capital gain tax you are willing to pay in any given year. And for a lot of folks, there may be times when income is lower than they expect it to be in future years. So you may want to realize more of those gains in those lower income years to take advantage of a lower tax rate, a lower capital gain tax rate, even 5%. Perhaps some situations you can eliminate it entirely, but nevertheless you have a lot of control over just exactly how much tax you're going to pay with a custom indexing plan. And then finally, a core and satellite approach, I think, has been a fairly common way to manage money for a number of years. And the core of a portfolio historically has been, at least in a lot of cases, not always, but a lot of folks prefer to own low-cost index funds or ETFs to deliver those market returns as a core of a portfolio, and for good reason. They're very, very tax efficient. They're going to give you the market exposure that I think most folks count on when you're doing your financial planning work, things along those lines. So a core and satellite approach has certainly been worthwhile, especially using those passive low-cost vehicles as the core. And then direct indexing option might be able to take it a step further. So again, the point would be to generate those market-like returns, just as if you were to own the passive ETF, in a more tax-efficient manner. So in those satellite portfolios, that's generally where you're going to be trying to generate in the industry called alpha or outperformance or higher growth rates. And there's a variety of different ways that you can do that. Especially today, we're very fortunate to have a lot of excellent tools and structures to deliver long-term growth in a tax-efficient manner. And this custom indexing is just kind of the next step in that path to delivering long-term after-tax results that people can be pretty happy with. So that's the concept with the core and satellite approach. And hopefully this has been worthwhile. Again, it's a newer concept for a lot of individual investors, but if you'd like to learn more, please reach out. We think it's an interesting opportunity for a lot of folks in the right situation. Thanks for watching. And as always, I almost forgot. If you'd like to follow along, go over to DivviWealth.com. That's DIVVI Wealth.com. Or you can go over to our YouTube channel and subscribe there to receive updates like this as we post them. Thanks again.